Okay. Thanks a lot, and I'm happy to be at World AI Show, and I'm also sure all the panelists are happy to be here too. So, gone through view about AI, how it could mess so many things in the society, but I think there's a lot of value that AI brings into businesses and how businesses are trying to utilize it to do much more better things, increase the, trying to increase their revenues or predict more about the customers. So maybe you can just start at the very end and tell us like how is AI helping the business that you are in today?
For us at KPMG, we work with quite a lot of clients, both locally and globally. And what we have seen is a big rush into artificial intelligence. And some of the results are what have been shown up on screen, some of the unwanted results. And what we are putting together, what we are helping our clients do is make sure that even as you're introducing new ways of doing business, your control environment is growing and is maturing just as fast as your technology is adapting to it as well.
Thank you, Chris. So, Commercial Bank of Africa, we've been championing credit models. I'm sure most of you know M-Shwari. It's a mobile savings and loan product in partnership with Safaricom. Recently, we've also launched an overdraft product with Safaricom called Fuliza. So for us, machine learning is at the core of what we do, especially in driving credit underwriting. But we are looking at expanding more into issues like customer experience, personalization, and security.
For us as the Madison Group, we are a financial services company. And obviously, you know that customers have had an outcry in the time it takes for a claim to be settled, and or the time it takes for the customer to get the right information in terms of their premium and policies in terms of how much have they paid and how much is the balance. Also, the pain points around retaining those customers. So we feel that this is the right time that we can disrupt the insurance industry and the asset management industry to offer customers the right products at the right place at the right time. So we are leveraging on robotic process automation to do that, and I'll explain more as we talk.
Okay, so let's get started with the first topic about money laundering, which I think as a country probably would be a very big topic to talk about, especially given the latest news for that. So given that probably all the other companies play some role in either handling, processing, or handling money, what specific thing in the money laundering process that AI could come and say, like, hey, we can arrest this problem in money laundering? So maybe you could start from the insurance company, because I think there's always a lot of insurance-related fraud to that.
Thank you so much. Yes, fraud is there because traditionally people didn't trust insurance because they would pay huge sums of money. When it comes to claiming for that money, it's not forthcoming, it's not fast enough, it's not paid fast enough. So there was lack of trust between the customer and the insurance company. So by leveraging big data and segmenting customers by demographics, by the kind of products they have, we have been able to, and we're still on that journey, of trying to track the behavior of that customer. And from that behavior, we're able to know what kind of risk do they portend. And from that risk, we're able to know what kind of products should we offer. So whereas the issue of understanding the customer, it's also important to understand that we need also the customer to start trusting us. So it's a balance between risk management and trusting the insurance company. So we are leveraging more of data analytics. But you see, data analytics won't work well enough if they don't have a bot that can transact that data and compute that data fast enough to give you the right insights. So it's a journey of people trusting the insurance. It's a journey of us being able to give the right products on time. It's a journey of customer convenience, agility for that customer, and also personalization. So what's happening with anti-money laundering? So what we have done is we are trying to put in place the Know Your Customer. From maybe, and what's the origin of this money? Is it from Kenya, is it from South Sudan, is it from Somalia? So you check those parameters, the source of the funds, the customer profile, and then you're able to know whether the source of funds are not credible, then after that you're able to obviously advise the customer accordingly. Also, we had a chance where we're able to kind of protect our reputation in terms of people wanting to clean their money via insurance. Obviously, most of the avenues for cleaning money would be real estate, buying real estate, or a policy, insurance policy, all other avenues. So what we've been able to do is trying to use algorithms to help us understand this kind of money. Where would it be coming from? What kind of a source is this coming from? Is it a credible source? And we've been able to prevent a lot of money being laundered through insurance.
Thanks a lot. So Billy, M-Shwari and connected to M-Pesa probably handles a lot of money. And for detecting fraud, there's probably much more easier methods, like a customer is just trying to do bare limits on what they're doing, and also there's another side, a customer is more regular. But in between you have fraudsters who are always changing their behavior, they're trying to always beat the system. How would AI help in trying to figure out this changing fraudulent behavior that it's always ahead of rules and regulation and business processes?
Yeah, so in my opinion, I think banks are still lagging behind in terms of fraud analytics. Most of the banks are still using if-then statements to try and detect fraud. But I think the emergence of fintechs is really pushing how bankers think. Most of the fraud analytics space is being played by payments, platforms like PayPal. So I think financial institutions really need to start looking at fraud analytics. For us, it's really important at how we detect fraud. At the core of it, of course, is the issue of false positive. You don't want to flag fraudulent and non-fraudulent transactions as fraudulent. And it's always a balance. How are you going to train your model to be accurate enough to detect fraud, and also not to flag those transactions which are actually non-fraudulent as fraudulent. So I think it's high time that financial institutions start to use AI in terms of fraud and AML. And I think it's something that the time is right now with the emergence of data. Like for instance, for M-Shwari, we do over 80,000 loans a day. So it's massive data, and it's very important for us to try and detect the fraudulent activities. So I feel like AI has a big role to play as far as KYC, AML, and fraud detection is concerned.
Yeah, thanks. I think you've brought us something very interesting about false positives and how much your accuracy rate is. And I think probably most of the time there's always a perception that AI will be 100% accurate. There's always an error rate that it misclassify something for that. So to you, and most of the time, a lot of fraud gets after an audit reported that could take 6 months, 10 months down the line. And so how can the audit process be made to be more predictive other than reactive to fraudulent transactions?
Well, that's an interesting bit you brought out. When you've just mentioned audits, then we have anti-money laundering, we have what is happening in Kenya recently, and quite interestingly, the central bank recently just issued a directive, I think it was yesterday, on directive for banks to audit their anti-money laundering policies. Now, what that then will translate into will be increased vigilance on transactions. And what that then will also translate into is CBK receiving quite a lot of transactions being flagged as fraudulent, or because banks are really trying to be up there and look like as if they're trying to stay on top of things. So while the banks are being pressured to come up with improved ways of identifying fraud and also anti-money laundering guidelines and also controls internally, the regulator also should be prepared for some of those things coming in as much as they issue directives and tell the banks to prepare for to do audits and to put in some guidelines. Internally, they should be prepared on how to address all these exceptions that will come in from the banks. We're saying if right now they're getting about 20 to 30 transactions a day being flagged as potentially fraudulent, with this increased vigilance going on and banks putting even bigger if-then-else statements, they will receive quite a number of transactions that are happening there. So then how can they now work on that, and also with the audits now? So what we're looking at is encouraging institutions to put in place continuous controls monitoring. Now, continuous controls monitoring leverages basically on the if-then-else first. Then we're saying in the future, some of these things need to come into play. For example, natural language processing, because most of the transactions in banks, you tell the individual to write on a piece of paper where they got the money from, where they're sending it to, and what they want to do with it. If you expect that type of information to be consumed by a teller one day, and from all the transactions that they're handling, and then come up and actually flag some issues here and there, you either risk slowing down how you're doing business with your customers, or frustrating them in the long run, because now they'll feel, I don't need to use you for transactions. Recently, I tried to make a transaction from my bank to another bank. I've been doing the same transactions for the past, I think, 2 years. So they called me after 3 days and told me your transaction didn't go through. We want to know where you're sending it. The narrative you wrote here wasn't clear. We're sending so I wrote an abbreviation for the company. So that happened 3 days after I'd done the transaction. Now consider if that transaction was a sensitive transaction. Probably there's a payment to facilitate a medical issue, or a student, or something that is time bound. And because they needed a human being to go and read that particular transaction, and he was worried that everyone is cautious, this guy looks suspect, let me call him. 3 days after the transaction has happened, you have put me at risk. So next time I want to transfer that money, I will send it to my phone, probably give that extra money to Safaricom to send it through that transaction. So those reliance on individuals to read the transactions day in, day out will not prove, scalable in the future.
But I think banks have an inherent disadvantage, because if you look at the velocity of transactions being made, if you compare, for example, like a retail outlet, you could go to the market 4 or 5 times a day. Yeah. That gives more information. Probably, like he said, they give about 80,000 loans in a day.
Yeah.
So they have more transaction to learn from. But from a bank, you probably do 1 transaction in 3 months.
Well, so then there comes in the concern about how much volume of data you're dealing with. And you're very right. Retailers have quite a lot of transactions a day, banks probably not as much. However, if you look at also the regulation of that particular, those two types of industries, the banks have quite a lot of regulation. The retailers have quite, less regulation. In terms of how they use their data, the bankers will be required to use their data more for defensive purposes. They are required to use that particular, as you're saying, that little velocity of data to do defensive purposes for their data, and they cannot avoid it. One of the things that is being proposed in the industry is using intermediaries who are probably offering the service. So a company comes to you and tells you, I have the algorithm to identify fraudulent transactions on insurance data or probably banking data. What I need you to give me is your transactions. I already have 3-4 other banks. I'm already identifying issues there. So using what I'm learning from them, I can then help you do that. So that ability to aggregate data across different financial institutions can also help banks bridge that gap of saying, probably we don't have as much volume of data as possible. But then there is no way they can avoid use of AI, because a recent research by Monarch Insurance said they noted that humans can only identify about 8% of errors in insurance data in terms of the claim that they're processing. When they put in place AI and so on, that went up from 8 to 80%. And that in itself is a big indicator that you cannot avoid the use of data and the use of artificial intelligence in trying to identify error in your data. Avoiding it because you don't have the volume of data, you're setting yourself up for failure. There are avenues to bridge that gap.
I think that brings us to another interesting aspect of the discussion about you're trying to share data with other companies.
Yeah.
And there's all about GDPR.
Yeah.
And a customer says my data can only be used for credit scoring.
Okay.
If the data is going to work to your disadvantage,
Yeah.
you're not going to allow the company to use it for purposes against you, which makes it very difficult for AI systems to flourish. And I think I was thinking about if you know about Mathri route, when someone misbehaves in the city, someone takes a photo.
Yeah.
And someone thought, like, hey, how about we build something for insurance companies so that when you overlap or, do something crazy on the road, it normally checks through a database, like, who are you insured with, and sends a message like, hey, this guy has been crashing people's windscreens along the way. But then that's not defensible in court, because it's like, hey, where did you get this data? You're even allowed to use that particular data. So do you think GDPR is a constraint to AI adoption in insurance?
Data privacy is critical for the customer to feel that you really care for them. So you have to balance between the interests of the customer and the interests of GDPR. So where do you start? You start by first understanding what data process owner concept is from the GDPR point of view, because they have outlined somebody called the data process owner that should be the only one processing data for the customer. But they cannot leak that data unless the customer has given consent. So you need to customize your AI tools or your bots to that kind of logic, where the customer comes first, because you don't want to lose that customer, you want to retain the customer. At the same time, you want to comply with GDPR or equivalent laws. We don't have GDPR in Kenya, we have got equivalent. So you want to balance that. And so this something they talk about in information security. They say you have to balance productivity and security. So if you want too much security, then switch off your computer. So who wants to switch off the computer? You want to work, you want business to thrive. So you don't switch it off. At the same time, you want productivity, you want sales. And sales means that you must resonate with the interests and the needs of the customer. So you must strike that balance. So we must make our AI, our robotics, very, very credible. We must make them ethical, and it's us to obviously adapt them to that kind of level. Them on their own, they can't do it. it's humans to adapt them to that. So there's the issue of the human element and the machine element coming together to work together. So it's a human and machine working in collaboration to meet the needs of the consumer.
Billy, I have a question. If fintech companies come and ask you, hey, can you give us M-Shwari data so we can use them on our apps? Would that something sound great because it will make their scoring better? Do you think companies should hold on to their data? Do you think GDPR is good for AI?
You're trying to fix me. But I think there are two key issues that currently are affecting financial institutions, especially banks. One is that banks are overprotective, and there's a thin line between being protective and being overprotective. And it's largely because of the regulation in which banks operate. But now you have fintechs, and a lot of them are not regulated. So it becomes, it then boils down to a question of ethics. We've seen cases where even some of these fintechs who offer microloans end up contacting third-party from your phone book just because you've taken a loan and you've not consented. So you can imagine you've taken a mobile loan, then your dad is being called to be informed that this person has taken a loan of 20,000. So I think the question of ethics is very critical. For me, the issue of data privacy is core. I don't think I would be open to share any data with third party. Data sharing should be at the consent of the customer. So for me, I think, and this is largely why you have banks are now complaining that these fintechs need to be regulated because some of them, the way they're operating is not actually ethical. As much as we are championing for AI, I think Alfred had just mentioned that ethics is at the core of how we implement AI.
Okay, so we need the customer to give us the consent to go around and play around with the data. But sometimes, whatever you need to do does not have a prior, do you go all the time and ask, we want to do research on uptake of insurance product on mobile phones, can we use your data? And could you offer the option, the customer, that you could sell your data to another company? Like, if I know I have, let's say, M-Shwari credit, and I say like, hey, I want to move my data to, let's say, Tala, so that I can have a higher credit scoring for that. Does that seem something good? Should we always go back to the customer and ask for consent?
It's both good and bad. But for me, I feel like the consent should always come from the customer. Because if the customer has consented to work, for instance, with M-Shwari, and how then do you tell that the customer, that the data you are going to share with a third party is actually going to be of beneficial to the customer? In the event that the data that you've shared is not going to be used correctly, then the blame will just come back to you. So it's a very tricky scenario to play in.
You've probably handled a lot of data from probably so many institutions. How do we ensure that this data is always used for the benefit of the customer and doesn't get misused?
You've hit the nail on the head. Yes, we do handle quite a lot of data from different customers. And that is what our brand also is built on, in terms of being able to maintain that data without having it used for the wrong purposes and shared with individuals who do not require it. So what we advocate for is being able to upfront define exactly what you need the data for. And once we receive the data, there are elements of the data that we actually do remove from the information that we do not, from the information that we've been given. Information that will likely identify an individual. That is one bit of it, just to make sure we don't need your, we're doing some analytics with your data, we don't need your address. where we're keeping that column in that particular data set that we're doing. Then on the other side of it, in terms of the way our teams are structured and the way our people work, those data sets are only availed to the group that has particular need for that project. And these are things that are always audited internally by our controls and quality team to make sure that is maintained throughout our projects. Second, after that, we have the contractual side of it, where we agree with the client and have non-disclosure agreements between us, and put in place measures to ensure that if anything happens and if there are breaches, there are consequences for that. And for us, we really care about that, and it's something that contracting is very important for us. However, I'm looking at it in terms of what the presentation that was there before. If you do not share your data, there are very high likelihood that whatever it is that you're learning from has already been how do you say, is biased towards the type of population that you kind of have. So you may feel that you're ready to face the world with the data that you've learned from, because you're walking around with the information that you have. The moment you expose yourself to the public, you then realize that this population that you're currently serving is not representative of the society at large. People then start hitting you with concerns about what your algorithm is doing, your reputation comes at stake, and you have problems at hand. So you do have to have some sense of sharing in between. Now, regulation is not designed to limit innovation. Okay? The same way that you fear the Lord doesn't mean that you do not live your life to the fullest. Okay? So I say the fear of the customer is the beginning of wisdom. The moment now you're afraid of what based on the regulations and what they're doing to protect the customer, you then have caveats within it to use that data to to your benefit. For example, if you wanted to find out whether, I'm going to use an example in healthcare, for example. If at childbirth, for the patients, for the people who undergo cesarean or they undergo natural childbirth, does that have an impact on professional success or academic success? There is no way you will find academic information in a hospital. Yeah, there is no way you will change how people go through childbirth if you're not able to link that particular impact in their early life to their career or to their academics in future. To do that type of analytics, you need to work with people who have information across both sides. The only way to do that is to share. Now, the regulations that are coming into place provide for that type of research and for that type of sharing of information. They put in place measures to ensure that the consumer is protected. One, in terms of giving consent, and in as much as you're saying people will be worried about what you're doing with their data, that's probably like a small percentage of the bigger population. Most of the people will be more than happy to. There was a research that was done, and it kind of said, if you promise me, for example, a reduction up front in my insurance premium, I will more than likely give you my personal data. However, if you promise that after, there is less likelihood of me giving you that data. So people are open to sharing data if you convince them or if you promise returns on what you're going to do with that data. Now, that is one in terms of sharing, giving the information. What you do with the information with a third party, it is possible now. For example, I was saying in the medical industry, what they're doing is something called data linkage. It's something that's very common in, I think, Scotland. What they're doing is data linkage. They have a body in between that the medical practitioner gives them data about, for example, the identifier of the individual. They then mask that data. They then take the data of the identifier of the same individual from the other party, mask that data. Then what they exchange between the two of them is they will give each of those people indexes on how to mark the data. So, for example, if your name on that side was Timothy, they will give you an index that only the linkage institution is aware of. So when you give the data to them, they will then remove all personally identifiable information, put the index in between, and then allow that data to be used for analytics. What you want to know is if the person went through normal childbirth, what was his success rate in school and also as a career, in his career. You don't need to know his name. You don't need to know where he lives. You don't need to know what he does. You don't need to walk down the street and say, that guy was in my data. I saw him. That's the guy. It's actually, my results are very true. You don't need to know that information. However, such bodies in between allow that linkage of data between two independent organizations, and they allow the person in between to make that analysis, still within the confines of GDPR, for example. So there is room for data sharing and analytics. However, so once you get the consent, you then need to work within the confines of regulation to do that. Regulation is not there to limit innovation. It's there to protect the customer.
Thanks for that. So now, getting into now the customer behaviors and how, kind of behaviors we're trying to understand about the customer in order to, sell more products to them or give them a loan or not. So trying to figure out some of the interesting things that AI or machine learning has figured out. I think one of the local example was one of these fintech companies that if you always call your mom, you always pay your loan. They figured that out. Or if you write people's names in complete words, not half, like you're always a trustworthy person. Some people dispute those, type of analysis that people figured out about that. So maybe just to what are some of the interesting, consumer behaviors that you've come across that either work for the benefit of the customer or against the customer?
I think one of the interesting things I've realized is there are guys who take their loans every Friday.
That's not so strange. it's a party day.
They take it every Friday and they pay it by the Monday. But the interesting thing is there are certain patterns, consumer patterns that you observe that really open up your world of thinking. We have guys who will consistently take loans towards the end of the month. There are guys who will consistently take loans towards the beginning of the month. But the key thing is then how do you infer that behavior? And I think that's where banks need to really up their game in terms of customer segmentation and pattern recognition. Is that once you have the data and you've identified the patterns, then what next? There's an opportunity to cross-sell. For instance, if I'm the guy who takes a loan every Friday and I pay it on a Monday, there's a chance for me to be given the loan at a better rate rather than being given a one-size-fits-all price for everyone. So I think what we do with the insights we get is of utmost importance.
Yeah. So do we have some funny patterns on insurance?
Yes, a lot. There was a story the other day in the papers about garages that are not able to handle Probox, Subaru cars, and some other cars are very expensive to maintain, like Mazda, and some garages are avoiding those kind of cars. And you know that garages and insurance companies work together to kind of get the risk rating for a particular model. So you see that for some models, like Probox, they'll be given a rating of 8%. So you want your car to be covered as a Probox, and you're a Probox driver, you're given 8%. And you know that for Mercedes drivers, they're given a rating like 4%. It's happening. Garages are working together with insurance companies to give the kind of rating that should happen. But also, we do a lot of behavioral research in terms of the type of driver, the way he drives, using tools called telematics. Telematics is able to tell you this person drives at this speed in these places at this time. And using telematics, you're able to know what rate you'll give that particular driver. So some drivers get discounts, or they get very low premiums because they're good drivers. Others are avoided, not just by one insurance company, but all insurance companies, because insurance companies exchange this data. So we'll see telematics happening a lot in Kenya in the next few years coming, and AI and analytics and big data will play a role in this. So being a good driver is good. Also having a good house that can attract less good rates in a good neighborhood also matters. So the house, is it in a place that's prone to floods, wind, fire? So insurance companies are checking that before they insure your house. The risk around that area, they are using geophysical mapping to know where that house is located and the kind of risk that is pertaining to that house. So property and cars, motor vehicles, they're being analyzed in terms of where they're located, the risk they're exposed to, and the rates that can be given for insurance.
You have more examples about that?
Well, probably one of them to show that what you had mentioned in terms of inference is it's happening. And I know there's a country in Europe where if there's a case of animal abuse reported in your household, immediately they start investigation into child abuse. The moment someone reports from the vet that, you know, an animal has been mistreated, or your neighbor reports an animal has been mistreated, child services walk in as well. They believe that those two go together: child abuse, animal abuse. That aside, we've worked with quite a number of companies in looking at analytics for fraud, and probably one came out as a false positive. We noted that we went in insurance, you know, cover in their data they can tell male and female, and in some of the diseases that are there, you know, some of those diseases are clearly gender exclusive. So when we were trying to do the analytics on some of our insurance, we noted instances where men were taking pregnancy tests, for example, and we at first thought that this is some high level of nonsense that's going on. But then when you dig into deep and you understand the society, you then realize it is not all men who cover or clearly states who their spouses are in terms of a particular element. So there are times when there are members or people who do not understand how their cover works. So I walk into the hospital with my wife, for example, and instead of producing my wife's card, I produce my card and we go ahead and do the treatment because I insist that I must be served, and they know you who you are, they go ahead and serve you. So when they send the data back to the insurance, it looks like a big instance of fraud. When you dig deeper, you find that particular person who's being treated either is still part of your policy, or probably in your mapping of gender internally, you probably mapped a male to a female at the onset. So that's one. The other bit was in terms of insurance fraud. We noted cases where the people who have very little, small claims, graduated claims, so you'll have radio claim, a small accident, a windscreen, another windscreen, you're being prepped for a bigger fraud. And that was very clear in the data. When we did that classification of claims, we noted that the instances where guys were doing small claims with, you know, slight graduations, highly likely the next big claim was fraudulent. And those are things now you need to look into. However, if you put that through an AI particular solution, then you have the chances of flagging out the guy whose neighborhood is next to a garage. They keep hitting his car, and then one day he comes home and it's stolen, and you will say that is a fraudulent case, but in the real sense it's not. So that bit of, you know, balancing between false positives and the reality is also very important in that place. The learning in your particular instance is also very key. You cannot just put AI and just walk away. Someone needs to constantly teach it and correct it.
Yeah, so it's so interesting. There's a very good book called Weapons of Math Distraction.
Yeah.
It talks about instances where AI, machine learning, and data science have gone horribly wrong.
Yeah.
And one of the aspects is, like, if you know someone lives in a poor neighborhood, so they have ambitions, so you can give them like very expensive loans to go to school because they want to, you know, further their ambitions, and plus other variables. And at the end of that book, they say, like, for certain types of analysis and for AI to be less biased, they say, like, there's 7 variables that should be removed from a data set. So one of them is location. You should never use location data in that prediction. The other one is gender. You can never use gender for that. Another one was race. You can never use race for that. And I think the other four were, I think there's like your bank, I can't remember the other four. But that makes it very, putting it back to you, if you want to insure someone who lives in Karen, versus someone who lives, let's say, in Huruma, and you've been told you cannot use location data because it already puts bias, it gives an advantage to someone living in Karen than someone. Is that good? And do you think there could be better ways of analyzing data, or for AI, so that you can remove the bias out of location, gender? Google example of, hey, we're not considering race.
Yes. Physical location is important when you're insuring property. It's very important because you need to know how fast you can respond to the fire, to a flood, in case of wind. How fast can you respond? So in that sense, then it makes sense to blank out the explain to the regulators or whoever needs to be explained to the importance. Okay. Also, geophysical mapping is a branch of it works together with machine learning, isn't it?
That's true.
And big data. So those technologies work together to help really the customer and the community. So at the end of it all, it's not about the technology that's being used or the physical location. It's about helping the community and the customer. So that should be at the center of all development or solutions.
Okay, Billy, do you think could be other variables?
I think I'll differ with Stanley. If it's in the regulation, then you don't use it. But I think it's, for me, the way I see it is, if then I'm not able to use, say, location data as part of the variables I'm using in my model, what I'll do is I'll try to substitute location with something else that can sort of infer the same thing. You can have a different variable that might infer maybe what you want to get from location. Maybe, for instance, location you want to gauge maybe ability of a particular customer to service the insurance. You can get that easily, say, from something like your number of bedrooms in your house, say, for instance. If I live in a single room as opposed to someone who is in a 4-bedroom house, I think the inference can be the same. So I think what we need to do is, and then you try to, when you have multiple variables, I think you then end up having a stable model that can be able to stand the test of time, as opposed to just fixing on one variable.
So, Timothy, so apart from removing personally identifiable information, the data set you work with, and not to fall into the correlation and causation bandwagon, so do you think there are other variables that should not be used, or others that should be used instead of the ones that people figure out that introduce bias?
So in that article, in that report, what they were looking at is variables that are most likely going to introduce bias in your particular algorithm. In as much as gender is an issue or location is an issue, change, the premium that you get in terms of your policy. However, what needs to be clear is that even after you've generated or designed that particular algorithm of yours, when you test it for bias, when individuals are making that evaluation, that is why you need to make sure that those variables that are being used do not result in undue bias. While, as a rule of thumb, avoiding them at first will help you reduce the cases of where bias will show up, but there are some instances where, like I was saying, in terms of house and area, and if there's sufficient reliable data on crime rates and sufficient reliable data on earthquakes and natural occurrences of events, then it's unfortunate that will determine your particular profile. However, it should not give you an undue advantage, and you should not bias that particular individual. So what you're saying, the moment females from Karen apply for a loan, they get it, they get it at a much lower rate than when males from Karen apply. How did you figure out females from Karen? The only reason would be, in your entire population, females look like they were much more likely to repay your loan, or more susceptible to follow-up, influence and follow-up, so they pay up. But then you need to analyze that particular result of your data and eliminate the instances of bias. Then go back to your variables and say, okay, fine. In as much as it's helping me figure out what premium to give, and it has a strong correlation to what I'm looking for, unfortunately, looking at the population I have, it's showing a very high skewness towards a certain group of people, which is not fair for the population. Then you have to go back and remove it. It's that consideration. Does that variable bring bias significantly in mind? But if it's a true representation of what your society is like, avoiding it is probably setting yourself up for failure.
Okay. You want to add something? You're just running out of time.
And I'll agree with that. For instance, males, we tend to default on our loans more, just because we have extra responsibilities. so I think using that can be, it's good, yeah.
Thanks a lot, Timothy, Billy. So just a quick 1 minute, so we can close. What's your prediction for AI in the industry? 1 minute.
So AI will augment other technologies. It won't work alone. It will augment big data, analytics, social media, mobility, and cloud computing. So we must leverage it. We must be ready for it. Thank you.
Thanks.
I think the way I look at AI in terms of financial services, I look at it in terms of 3 segments. I look at it from the front office, middle office, and back office. I think for back office, banks are really doing well in terms of underwriting. Most of that is automated, and we have machine learning. But we still have, we are still lagging behind in terms of front office issues to do with chatbots, voice assistants, and middle office in terms of fraud and ML. So I think my prediction is within the coming years, I'll see a lot of banks moving into bots and voice assistants as we proceed.
Thank you.
Okay. For me, my prediction into what's going to happen in the next couple of years is the regulators are going to get more interested in what financial institutions are doing with artificial intelligence. We are going to be the beneficiaries of learning from other developed nations where they have been moving at a reactionary pace. And in as much as we are attempting, and because other people are recognizing that Africa has, insufficiency of controls, and probably quite a lot is happening here, and there's more room to play around. I think in the next couple of years, regulators are going to wake up and start looking and asking questions, or requiring financial institutions to step up their game in terms of analytics, and also the use of artificial intelligence, both in terms of defining how it should be used, or probably requiring that it is part of their particular offering of services, or probably, as you say, in the ML space in that regard.
Thank you very much, Billy, Timothy, Madison. A round of applause for them.